Looking for a real estate loan? Should you get a loan from a bank or a credit union? We got answers for you today. 10 years ago, Mark Ritter started Members First Federal Credit Union's business lending program to help credit unions work with small businesses owners and real estate investors. Welcome to The Truth About Real Estate. I'm your host, Matthew Ma. Excited to talk with you, Mark. Welcome to the show.
Matthew, thanks for having me. Looking forward to the conversation.
Cool. I wanted to start talking to you about, first off, let's start talking about what is a credit union anyways, and how does that work with real estate loans?
Sure. That's one of the most misunderstood pieces of my business because a lot of people drive past a credit union and they see an ATM. They have drive-through lines. They over 125 million people belong to credit unions in the United States, but they just don't understand what it is underneath. And the easiest way to think about a credit union is it's a not for profit financial cooperative. It doesn't have stockholders like a commercial bank would. It is run by a board of directors that's elected by the members. And really, it's for the members by the members. So that structure allows them to be more people focused as opposed to shareholder focus, where you don't necessarily have that big picture. Now they still have they're federally regulated, federally insured financial institutions. So they still have to do things in sound lending practice and good financials. They can't give away everything, all their money to everybody who wants it and might not pay it back. So they're federally regulated, but it's really a financial cooperative, and how that translates through to people with their experience is generally that they're very customer and member focused, in that you have the account there and they can work what's best for you and talk through the business as opposed to being a little more, I hate to say, a little more cutthroat and bottom line than the banks that you may talk to.
Nice. So that's a good part of it too, because yeah, you're right. I think most people don't understand the difference between banks and credit unions. A lot of us drive by it. We don't know about it. We don't go look into further how it works. And the people who know about it. But for the rest of us, it's something different, right? And we're not used to it. How does one even become a part of the credit unions, anyways?
Sure, good question. And that has changed a lot over the years. And I remember when my father was growing up, the factory that he worked in had a credit union. And he always said that was the place he went if he needed money and to get a loan. And back in those days, they were, I hate to call them corner of the factory, but there was a school teachers credit union, a police officers credit union, a firefighters credit union. It seemed like every factory or employer group had their own credit union where it was really just for that people. And credit unions really have evolved and become much more diversified over the years. And I would tell your listeners, if they're driving home from work today or out and about and they're driving past a credit union, there's about a 95% chance they could go in and open an account. And you see credit unions that may serve a particular geography. There might be a credit union that says, we serve greater Los Angeles in these particular counties. Or they might be open to particular employer groups or associations that you can join to be part of the cooperative. So they've many years ago, it was you had to go to this particular credit union that you or your spouse worked for, but they've really broadened up, and you can apply for a loan and work towards a loan before you become a member. But ultimately, yourself or whoever the entity is that owns property and wants a loan from a credit union, you'll have to become a member. Now, that can be as simple. Most of them, maybe you have $5 to $20 that you have to open an account, and you're a member of the cooperative. But really, you also, once you're in the door, you have access to all of their checking accounts and savings and investment services and loans that you would have otherwise. So many people I talk to say, oh, I have a loan at a credit union because maybe they had a good auto loan rate. Well, we're better to maybe get that relationship for your real estate loan than where you have a relationship where they know you have good credit and they've seen your loan payment history and they're really working to expand your relationship versus you know what it's like when you're that first time you meet with somebody and trying to get a loan from them is a little more difficult than maybe where you have that existing relationship.
And I think one of the hardest parts for consumers is that there's so many different options. Which one do I spend my time and effort to apply for, to learn about, and to figure out? Some people just go with what their lenders, what the recommendations from their friends, family, or a realtor says about which one they should go with, and then they just do that without really researching a couple different options. Another thought process is that if I apply to more than one company, that it's hurting my credit score. And there is a difference between soft pull and hard pull for you guys to understand. But talking about this, there's just so much to do, right? And as a consumer, you feel overwhelmed by the process because how many applications am I filling out just to get information based on rates? For example, some people say, hey, I want to just call you and ask you, could you tell me, could I qualify based on this general scenario? And what kind of rates would you have for this general scenario? Some lenders say, well, I can't tell you until you fill application. And then it kind of defeats the purpose because now you're asking me to do all this work upfront without even having a general sense of what you guys charge because they don't tell you the open floor rate. And that hurts because like how much time do I need to do this application, right? I can't just copy and paste it to every single website company, right? I upload all my
It,
documents over.
it almost reminds me of watching TV today. I have 10 streaming services and 200 channels, and it feels like I have nothing to watch ever.
Yep,
There's so many options, there's no options.
exactly. Overload.
And to give you some insight, that's why I really enjoy what we do, is that MBFS is and credit unions have only been in the commercial space so maybe it started up 20 years ago, but really the last decade is when it's came upon itself. So what the credit unions have done is instead of every individual lender forming their own shop, forming their own originations team, forming their own back office, buying their own software, they form these companies like us throughout the country where people can go to and have a conversation. We're owned by 12 different credit unions, and we work with about 85 credit unions all throughout the country. So we can help guide people to get them to that right fit before and hopefully cut out a lot of that pain points that you do, because so many people think lenders, just because somebody lends money, it's this homogenous industry where they're all the same. But the reality is everybody's different. There's lenders that are looking for people with poor and marginal credit. There's lenders who only want to lend to the top 1% of credits and the ones with no risk that will give you the money. And then there's people like us where we deal with a little bit of everything. We deal with maybe that first time investor that wants to buy that first residential rental property up to $20-30 million relationships in the commercial industry. And that's where I really think exactly what you said is dead on. You need to research it and talk to a few lenders and interview them before you take those next steps to get a feel for, do they lend to people who are at my phase of the business? And do they lend to people who where I'm going and want to be? Because it's a lot of work. It's a lot of energy. And there's nothing worse than getting a few weeks into a deal and somebody says, we can't do what you want, or we're changing the terms and the market's changed. And then you have to start over, or the deal falls apart. That's reputation risk for you. So it's crucial for people to get those references and talk through. And I'll pat myself on for the credit union industry, is that's where it's nice because a credit union is there for the members. So people have that trust a little bit more that we're going to be fair on rates, fair on terms, and throughout the whole process, so that you have a little bit more of a trust factor with your credit union. Nobody's out there on the streets protesting against their credit union for unfair practices and that they hate their credit union. It's more of a nice puppy relationship where people trust us, they like us, and they continue to build off of that.
Yeah, and I think a part of it too, and like I used to be a lender a couple many years ago, and I really want to talk about, especially in today's market, and some things you brought up too. Like we really want consumers to understand not all lenders are same, and I'll give you a couple of different examples, and you can tell me about it too. There's a difference between retail, wholesale, and correspondence loans. What does that mean for consumer? For example, let's say big banks, they might charge you a higher rate, maybe because of one thing. They have to pay for the offices, the overhead, the marketing, everything. There's a lot of expenses in there. How do they make that up? Back in the loans, right? So the loans could be higher. You got depending on what you're doing. The wholesaling wise, let's say you have a mortgage broker and they have a small shop or an online shop. They might not have all this overhead. They might be able to give you a better rate because of the reduced overhead. And it's the same program, right? And it could be the same bank. It's a different rate. You have to understand that there's options there for you. Another part of it could be that if you are a top 1%, you might have, what they call private client benefits, and you could get a reduced rate even because of you having additional assets such as 250K, 500K, a million sitting there in their stock portfolio or reserves. But you want to understand there's different options out there, and not all brokers are the same rates. They might charge more because they're saying, for example, here's the cheapest rate for the product. Here's me because I just charge more because my work is better, whatever. And then here's retail. Those are the options within that. And you have credit unions as well. So it is tough, but it is part of a loan that you're buying one of the biggest assets in your life. Consider looking and understanding it. Not all realtors, investors understand there's different types of products out there. They might refer you to a friend, but you really want to look out for your interest for your family and see would be the best option. It takes a little bit more time, but that's where the savings comes along, right? And the trust
One
factor
of
is major too.
one of the things that is a real legitimate question to ask: how is my loan being funded? And it's such a simple question that people sometimes overlook it. And what I mean is just what you talked to. If you're talking to a broker who's just and sell it on the open market, well, that costs money. They're looking at it for a short term. Whereas in my space, credit unions, for every dollar of deposits they get in, they're typically lending out 80 to 85 cents. And they're not borrowing because borrowing money and lending it back out is a very expensive proposition and it runs on very thin margins. So you have to make that. It is always cheapest and best to lend out your own money. And that's where what that credit union will lend out about 80, 85 cents of its own deposits with a very low cost of funds. So that's where it can afford to give you a good rate. And I'll give you a good example. No loan a credit union can do at a federal credit union can have a prepayment penalty, which is a huge advantage for real estate investors because many times you want to cash out that property, you want to sell it, you want to hit the market at the right time and buy something else, or the market shifts. The rates, 2 years ago, we just went a sharp downward rate, and we found many people who couldn't refinance because they didn't understand the lender that they were dealing with and the terms that they had on their loan, and it was going to be a very substantial penalty to prepay that loan. So you have to understand that lender of yours on who they are, where they're getting their money, what does their balance sheet look like, and as you said, that's a trust factor.
Yeah, and a part of that too is when I talk to lenders now, as a real estate agent and broker, I talk to lenders out there and I ask them all these different questions to really understand who I'm working with for the client, benefit and see how they can work. Even then too, I heard there's different terms of correspondence too. Like for example, if your bank or your mortgage broker does a lot of business with a bank or a lender that funds the loans, they can get a better rate than someone else who just does a little amount too. Or even exceptions. Let's say you have a complicated loan because you're a small business owner or you're a real estate investor. There's some lenders out there who can get better exceptions based on your criteria because they're more experienced on it. They know how to package the loan so it qualifies and does everything needed. While others might say, "Oh, that's a little bit of work. I don't want to do that." Move on to the next person, or fail in the middle because they didn't know about that. So that's part of experience and trust, and really knowing who you're working with and how they can help you based on your situation.
Yeah, it's, there's nothing more frustrating than a small business owner who somebody has a bunch of residential properties going and trying to get a traditional 30-year Fannie Freddie conforming loan. And sometimes I'll say the mega shops, the volume shops, they go work on volume. They're going to lend in a box. They're going to find a lot of people in that box, and they're just going to repeat it as much as they can. Where on the other end, your extreme smaller lenders sometimes struggle to make those changes because they don't have the flexibility or the capital to maybe hold that loan in house. And that's where I really think sometimes the best options are those happy mediums where you can have a conversation with people. And particularly, look, like as I said, if you're in the top 1% and have great credit, you can walk into any bank credit union and get those primo deals. But for many people, that's just not the case, and you have to have a conversation. To me, it's a huge red flag if you can't have a conversation with your lender to discuss what they can do and discuss your particular situation.
Yeah, I think you get sense that in terms of volume wise, like when they're buying a house in the market, and they say that oh, we're busy, we can't really sit down with you, talk you through your loan situation, and explain everything. And even some lenders right now, some good lenders are actually doing still doing pre underwritten approvals, and that pre underwritten approval makes you feel more confident, especially in a competitive market like San Francisco Bay Area. Some lenders do only pre-approvals, is just like, just pretty much just really the base bare minimums to qualify. While some lenders let you do pre-underwriting, where they're still underwriting all the details, saying you're pretty much good to go. All you need to do is find the property, get in contract, get your appraisal cleared, making it habitable and valuation, and then go forward and close in 21 days. While other lenders take 30, 45 days. So there's a difference between the rates and what's going on with the current market it is in today.
Yeah, absolutely. It is such a rapidly changing market that you need people who can be responsive to your needs. And whether it's your primary residence or an investment property or a mixed use property, the market is fast and the market is constantly changing in some different areas. And this is still a hyper local business. Whether you're in small town America, mega city, somewhere in between, it is still a hyper local business, and you need people who can be responsive to you as it happens to get that deal done. Because the sellers today they have the leverage when it comes to the terms and conditions of the property and of the loan and of the down payments and who can do what. And to be stuck with a lender who can't deliver, that's a tough situation, and people just need to be careful about it.
Exactly. And let's talk about this too. Do you guys do FHA loans, VA loans, any hard money loans inside within it?
So so the credit unions stay out of the hard money business.
Mhm. You guys, yeah.
Um, So they really, because that's a tough, and because credit union, we also tend to have a max interest rate of 18% set by federal law. So a lot of
Mhm.
these hard money short term loans, we stay out of. The credit union industry, and there's actually from my company, I'll deal with about half our business is residential investment properties, and our sister company does credit unions do all the traditional FHA, VA loans, Fannie Mae conforming, and move to everything, the USDA, everything on the traditional third party support, third party loans.
Okay, nice. And then you mentioned earlier too, for real estate investors and no prepayment penalties. So that's a benefit too, because like for example, some banks might charge you a prepayment penalty like 6 months, a year. They might have a step down 5, 4, 3, 2, 1. Really depends. But for how does that work for credit unions with no prepayments?
Yeah, so and that's one of the benefits of we're lending off of our own money, and I'd like to think it's us being nice, but it's actually by federal statute that we can't charge a prepayment penalty to the borrowers. And what happens is from our side, yeah, it stinks when rates drop suddenly and we have to refinance a good portion of our portfolio. But credit unions are so strong financially with their equity positions that it really doesn't impact us all that much. And it's a really good benefit because everybody, when you're buying that residential investment property, especially those first few ones, it's more about getting the loan, and you don't understand the back end of these loans, where you have to maintain certain covenants, you have to maintain conditions. Many times you'll have to give people updated financials on your investment property loans. So, and as rates drop, if you have a prepayment penalty, you're stuck with it up until typically maybe that 4 or 5 year period. And in the investment world, that's a long time. Just because you may get into this property and realize I want to get out of it, or you want to upgrade, you want to sell a couple of your single family units and buy a 10 unit property. You have that flexibility with us. So it's a great benefit to our borrowing base to keep that in a prepayment penalty. And it's one of those things that I just seen too many horror stories of people who didn't understand their loan documents when they signed them. And one of the pieces to remember for your listeners is when you get a car loan, when you get a credit card, when you buy a residential mortgage, all the laws are in your favor. There's disclosures, there's understanding, there's cooling off periods. When you do something for investment purposes, none of the laws are in your favor. The law is assuming this is a business transaction and you understand and know what you're getting into. So the lender has great flexibility to do what they want, how they want, and you have to understand that and be able to negotiate it, because you don't have those consumer protections that you do with other products that maybe you've used in the past.
Yeah. What kind of investment loans do you guys provide?
Sure. We work from the simplest of simple of 1 to 4 family residential properties. And many people that we work with, maybe they have a full-time job, or they're a real estate professional such as yours. And this is more supplemental income, or it's a retirement plan. We deal with, or maybe it's just student housing and you're located near a college. One of the most common loans that we do is a mixed use commercial property, where maybe there's a small storefront on the bottom and a few apartments up top, where you do have that stable residential income and you can get a little bit more on the business side. Up to we do apartment units with hundreds of units. We do hotels and hospitality loans. We'll do commercial real estate, office buildings, and another chunk of our business is with the small business owner who's purchasing the real estate that they're in. So,
Nice. So basically residential and commercial loans.
and even getting into, if you're a business owner, as you expand, you may be a real estate investor, but eventually you become a business owner. And if you need working capital loans, SBA loans, lines of credit, we do the whole gamut.
Okay. That's good to know too. So basically, like you could be a one-stop shop where you're starting off investing with the 1 to 4, and later you upgrade to 5 to 10 plus unit, and you guys still can still handle loans, and you get the relationship over time.
Yeah, and credit we're credit unions are cooperative business. And but one part of being a cooperative business is they also work together. So what we do in practice is those 85 credit unions that we work together with, we pull their resources together to expand their lending capabilities. So, a credit union might only be a few $100 million. And, if you're a $500 million credit union, that you may have a maximum lending capability of $2-3 million. Well, you're in San Francisco. What does $2-3 million buy you these days? Particularly if it's a commercial property.
Yeah, not much.
Um, Not much. So your lenders are going to have to pull together on the back end, and that's a big function of what we do is getting people access to this credit union money, but bringing them together. So with the lending power of our credit unions is much bigger than they are individually.
Nice. And is there like a difference for a consumer standpoint? Is there a difference when I go to a credit union versus a bank and I do application and I submit my forms? Are you guys asking anything differently, or just because I become a member once I get the loan, or if I'm already a pre-existing member?
For that first loan with people, what I like to tell you is the financial side is almost identical. We're going to be pulling credit. We're going to be getting the same tax returns. We're going to be doing a lot of forms. You're going to say, I submitted this to the bank. It's almost identical. So that's the financial side of your process is going to be very similar. Where I think the differentiator is in qualitative side, where we're asking the questions to try to make a deal work or talking through the process versus just putting it in the meat grinder and it either comes out with an approved or declined because it fits a box or not. So we really try to especially for those first deal or two, because we want to understand who you are and what you're doing, but more importantly, where you're going to make sure it's a good fit for us and it's a good fit for you. And if there's any issues that we have to work around, let's talk through them to try to make it work. But sometimes financial analysis is financial analysis, regardless of what lender you're going to. Some of that is the same in universal, and then it's always. I always tell people that first loan may seem like you're pulling teeth a little bit, but as you move forward, it gets a little easier.
Yeah. And a question sometimes we ask is if the person got a pre-approval in a rate on, let's say, a rate, and that rate was better than your rates for the same date, for the same everything, would you guys match them or beat them?
We can talk to a certain level.
Mhm.
I always look at it as the total picture
Yeah.
because in our world, under the commercial side, a rate is one piece of it. We want to know what the origination fees are, what the prepayment penalties are, how interest is calculated, and what other terms and conditions do they have with the loan. Because unlike your traditional owner occupied mortgage that you get, there are so many variables when lining up competing offers. But we do have conversations with people to you know it, we want to offer the best total package in the total picture, and not just simply wave rate around as the cheapest of the cheap. Because at some point, money costs the same for most people, and maybe in certain lenders it costs more. So if you're going to compete, try to be the cheapest on the rate, as you mentioned before, they have to make it up somewhere else.
Mhm. Yeah, and a good point to that is really to understand the back end of things. So when you look at the rate, only the rate, then you're missing the rest of the pieces that you just mentioned. You got to make sure everything else is the same to be fair. And yeah, I see that sometimes. I see some lenders actually match it or beat it based on the exact apples for actual apples. I see some people say, "Oh, I give you a better rate," but when you look at it, it was not better rate. Everything else behind the scene was totally way worse. So then I want consumers to understand that it's just not about rate; it's about everything combined. Another part of it too, you mentioned for investors. Am I able to do a Airbnb property, a fix and flip property, a total rehabs, and can I get 100% loans?
Yeah, we usually we're usually looking for some equity in the loans.
Mhm.
If it's a real if it's a real gut job renovation and maybe some rough around the edges, that's where I always tell people sometimes you're better off going to that hard money loan.
Mhm.
If you want 100% and going to renovate it and it's going to be something at the end, that's where I see us going into the properties more where you're going to renovate and getting those, and then we're lending off a stabilized value. We do Airbnb short term rentals pretty regularly in the different areas. One of the things to remember when for people who are doing short term rentals is sometimes they get excited off of the income on that because as you know you can make a lot more money on a short-term rental than you can renting a property out to a family for 12 months and that's part of the beast, but really in the valuation side, if that property you sold that property and somebody moved in, the value isn't necessarily off of that rental income because we almost look at that rental income more as a small business unto itself that you're operating and moving. So we're going to look at that, comparing it to a stabilized rental property versus a short term rental where you can make many times more, but you're not going to get all of that valuation in your appraisal. And that's kind of a standard that's really a standard in the appraisal industry.
Yeah. And another question they had too. So actually, going back, you're able to do fix and flips as well. Like Airbnb, we can do that. You can do that.
Yep.
Fix and flips, not 100% down, but like, as long as you have some equity in it, and
Yep.
maybe as long as it's probably habitable for appraisal
But
wise, it has to be habitable enough. Then you can do a fix and flip too, right?
yeah, and one of the things that we'll also have that conversation about you is we want to understand how you're going to do that. And I like to use myself in as example. I can barely fix my toilet when it
Mhm.
leaks, and I'm horrible at taking care of cars, and I'm lousy at fixing things around the house. If I do a renovation project, you would not want to live in this house, and you probably wouldn't want to lean against any of the stairs because they would fall over.
Yeah.
So we want to understand, are you a contractor who's going to do this and you really just need to buy the material and you have the resources to get this done? Or are you just simply going to outsource everything to your local contractor? It sounds, and if you're going to outsource everything, uh, you know, can you get in today's market? Can you get the fixtures to fix them? Can you get the washers you want and the tile you need and everything? So we want to understand that process to make sure you're not getting in over your head. Because one thing to remember about your lender is we want to get our money back. And we also see a lot of situations. So if we're asking questions and seeing other type situations where we want if we think your numbers are way off, we're going to tell you that and take that as good advice, not because we don't want to lend the money, but we want to get the money back. And we've seen this before, and we can also tell you what's going on in the marketplace around you, and we have access to information that you may not have on an individual basis for you.
And that's a good point too. I always tell investors it's nice to have a second pair of eyes, even a third pair, even from hard money lenders, credit unions, banks, because you want to make sure what they're seeing and what you're seeing, and to make sure it aligns with being able to be profitable. Because sometimes you might not see, hey, this property is actually not that great. Here's the issues we see. Here's the number you tell us, but here's the numbers we think it is based on our projections of all the other loans we see in this exact area. Consider these, and it might be good or bad, and that helps to have another pair of eyes looking at your deal.
Particularly if the bigger marketplace you're going into. In today's world, it used to be everybody bought property in their neighborhood because they knew it and they knew what was going on. Now, a lot of investors, you can do the Google Me right and look for properties and find properties in different areas and buying in different marketplaces or just farther away from you. From where you're at, if you drove an hour, you could be in 3 or 4 different marketplaces away where you might not understand the rental income as much as you think you do. Or you might not have your contracting team and your main people who you're going to rely on might not go there. So you got to make sure, take that feedback that we give you on a good basis so that we want this property to succeed.
Nice. And what kind of timelines do you see for credit unions? You know how, like, for example, when I talk about timelines in a purchase agreement, there's going to be an appraisal timeline, a loan contingency timeline, and a close of escrow. What do you normally see in credit unions?
Yeah, we can get you we're going to be able to get you very fast no's. That's why I'm really like, if we can't do this deal, we're not going to drag it out. We're just going to say it doesn't fit, and here's why we can't do it, and this is what we see. Tell it, and most of the time, we're not just giving you a no. We're trying to talk through it to see if we're missing something. Many times, under the residential investment side, or even the commercial investment side, now that's going to be longer than your primary mortgage. The approvals for primary mortgages, they're pretty heavily regulated. If it meets this, boom, it works, and it doesn't. If it doesn't, it doesn't. Usually if you can get a preliminary approval in a couple days and a final approval in 7 to 10 days in the investment side, that's pretty good. Some people, if it's somebody you worked with before, it should be less. The big X factors that we find today are the the other inspections that may need. And for example, if you're doing, this may be your first commercial property where there's a business involved. Most lenders are gonna want to do some basic environmental due diligence behind it, and that could be an extended period of time. The toughest market estimator today is appraisals. We need more appraisers in this world.
Yeah.
And the X factor of getting appraisers and not just appraisers who know that marketplace and can put it together in a timely basis is something that we always say we work much faster than the appraisers. So those are the pieces today that worry me the most in getting all of the service providers up to speed and getting those in a timely manner.
Any general timelines on appraisal dates? Like, how many days do you guys need to generally get appraisal back?
We've seen 2 weeks and we've seen 2 months. So it really depends on the type of property that it is and the types of valuations that you're looking for. If this is if it's simply a residential property deal, we're using it on standard industry forms. If your property has a commercial component to it where it's not considered residential, that's where they're giving you more of an appraisal that looks like a book. And there's less of those appraisers than there are residential appraisers. And many times they're very busy. So, but we generally, good rough is 3 to 4 weeks in today's marketplace. But
Okay.
if you have that commercial component, you really need to think about maybe some other factors that are out there as well, like environmental and leases. If there's tenants in it now, getting everything transferred and doing those in a timely basis. Investment properties can sometimes take much longer than a residential property. And that's one of the big changes that we're seeing in today's marketplace with people getting burned because deals change. And I don't know if anybody has mentioned this, but rates are rising. So the loan that you may have done a loan and projected interest rates and profitability. Well, a couple months later, those interest rates may be significantly higher. So, did you lock in at the time, or is your lender floating this a little bit more towards closing? And it's not just your house where you're paying a little bit more in your mortgage payment each month. You have to be able to make sure that you can carry this through and the deal still makes sense with tenants, and you're going to have that income that you can work with, because the margins on these properties are thin. When we look at how much income in compared to the tenants in today's world, it's a thin margin. So
Yeah, it's definitely a changing market right now with the rates rising so drastically. Like even for us, from 3% to 6% for some people, right? That's crazy. I think something that consumers should be aware of right now is like make sure you look at the down payment portion and the rates. Can you do 20% down, 25% down, 30% down? The rates do change drastically from that point of view, and each bank credit union has different rates based on what you're trying to do there. But I even today I've seen rates in the 4.25 rate with a 30% down, while normally conventional 6% plus for 20% down. And if that's something you can do, take a look at the numbers, which makes the most sense for you. But that could help some people with it if they have enough down. But in the San Francisco Bay Area market, it is really hard to get a good down payment when the prices, even for a fix, are starting at 1.6, 1.7, right? For single family houses, even 1.8. So it's tough. I get it. But seeing what you can do and understanding the different variables helps. Appraisal, loan, and closing, everyone has different timelines. I see here in the Bay Area, for some appraisals, 10 days up to 17 days on average. So just a mix of that for residential side. When you go to bigger investments, it's going to take a lot longer because, like you mentioned, there's a shorthand of appraisers out there. There's a lot of work to be done. There's not enough appraisers. They can't get it done fast enough. Everyone wants it done tomorrow. Not possible. But you have to understand what the general timeline is for today. And if you're pre-approved today, you should double check it again to make sure, are you still pre-approved, because the rates have been going up so quickly. So
we always talk about, and you hear the stories of 1982, and I got a mortgage for 13 or 15 or 16%, and we thought we got a great deal. But and the housing market survived, and everybody was making loans at these rates that were. But the biggest difference between the 1980s and today is the valuations of the homes and the payments compared to people's income is significantly more. On those, most of the times, they might have had a 30, 40, $50,000 home, even in San Francisco back in the day. And yes, you were paying interest on it, but it was still a relatively smaller percentage of your income. Whereas today, that larger payment is significantly a higher percentage of your income. And hopefully there's a slowdown. Nobody wants to see inflation. I understand why rates are rising. It has to. We got to do something about inflation because we're paying for it one way or another. But it's going to be interesting to see this market evolve because many investors and even borrowers, they've never been in a rising rate environment. They weren't alive during an environment like this. So they have existed in the past, and we'll get through it, but we'll see.
So let's talk about that too. Like, based on just your experience in your opinion, like the rates have jumped so quickly from 3% to 6%. And we talk about inflation and the rates changing so quickly. What do you think is going to happen for the rest of 2022 and even 2023 right now?
We think all our projections are hard rate raises through the remainder of this year.
How much higher, you think?
We think the prime rate will settle in between 4 to 4.5%, probably 4.25. So you're really talking about a 4% rise in rates this year overall, where those mortgage rates may be in the mid sixes and start to level out. And really from our economic standpoint, what we think is that's what we think that's going to do is skyrocket the potential and the opportunities in the multifamily and the residential investment properties.
Why is that?
Well, people need a place to live.
Mm-hmm.
And if they have a job and they're employed, they're spending more. You know, that one of that first bills that they're going to pay are their rent each month. So, and one thing also to keep in mind is the tax law changes put in under the Trump administration. They really negated the benefit of home ownership, where many times, when I was growing up, own a home, you're going to write off all the taxes, you're going to write off the interest, and there's a big benefit to that. In particularly in San Francisco, in New York City, even in the suburbs where I'm at, my state and local taxes don't get written off. My real estate taxes don't get written off. So when people do the math, the net effect of renting versus buying, and it isn't as dramatic as it once was under the previous tax code.
Mm-hmm.
And the other pieces that we're seeing is a tremendous shift in the work from home culture, where people can move out. If you talk to somebody who is in Salt Lake City or Boise, Idaho, we see a lot of California license plates. So people they're going to rent. Now it takes a long time for rental properties to come onto the marketplace. So the pandemic really squashed a lot of those plans, and the cost have squashed a lot of those plans. And people, with the increase in labor, with the increase of cost of goods, people aren't building all of those rental properties that they have. So when you have it on your hands, you can really get a good premium. Now there's a cap to that, and I think we're going to find out pretty soon what that cap is, because eventually people just say, I can't rent any, I can't pay anymore. So, but unemployment is very low, which is a positive. And even if unemployment goes to 4.5–5%, that is still historically low. So we see people with jobs, we see people spending goods, we see people traveling. Last week we were in Orlando, Florida, and I can tell you it's really busy if you're going out. So we see, if you're an investor, jobs and income are that key for your ultimate cash flow. And even with the higher cost of goods, people are going to be paying their rent. They're going to be finding a place to live. If they, I am sure that you have neighborhoods that where people have been priced out of. Well, they're moving somewhere. So they might not be buying. They could still be renting, but they're going somewhere, whether it's in your local marketplace or they're working from home. We've really switched to a virtual work from home company, and we've had people move. So we see that as a shift that isn't going away, and it's going to take a few years for this whole marketplace to level out in terms of real estate supply and demand.
I think one part right now, like in my market, I see sellers are still expecting high price premiums for their houses right now, even though they understand the rate has changed drastically and the purchasing power went down, the multiple offers went down, but sellers still want that high price like it was 6 months ago. And we tell them, things are changing. Is going to get a lot harder, and imagine your mortgage going up a couple $1,000s just because the rate went up, and your price point at 1.8, 2 million plus is going to affect a lot of people. But even then too, with inflation going on, and you see the prices for milk, for oil, for gas, everything is so crazy. Like gas here right now is for premiums like $6.65. It went up to $6.95, and people are like, that's insane, because you know how much you spend per week hitting probably over $500, $600 a month just in that alone. Like everyone's posting pictures of $120 gas per week, right, on their social media. But that hurts.
I
The work from home helps a lot too. Some people being able to work from home, but what we see right now in the tech market is a lot of tech companies are doing a lot of layoffs. But I would say they're more turning over the fat and really trying to hone down on their expenditures so they can really stabilize themselves for the future of in the risks coming in right now.
Yeah, and I really see there, and when I see some of the layoffs in the tech business, as somebody who's not in the tech business, I look at that and say, oh, they were probably a little bit overbought anyway. They got capital and we're higher, 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 and
Mhm.
it's getting now. Now here's the good news compared to 2008, 2009. Those people will get jobs. They might not get the exact job that they have with all the cool stock options in the room with all the snacks and every other, but they're going to be able to get jobs. Some of it might not be jobs in that marketplace, or they might go to a new marketplace, but they're also the net that they can put out and work from home. They could work for a company from New York. Whereas you couldn't do that in the past. We find that people always ask about our hiring practices, and they say, "What's it like hiring people?" I said, "It's not a problem because we'll hire somebody wherever they live." And if you're able to, if you now that's not everybody. If you're a welder, you got to be in the factory welding where you are. But in the service center tech industry, which really dominates, the major metropolitan marketplaces, the good news is you have flexibility. You can work for a company in Austin, Texas, and then maybe you could move there, but you don't have to right away. So we're this this is an oversupply uh, issues that we're having. It's not when we have demand problems, and that's where I'm much more worried. If people weren't buying milk, then we have problems. People are trying to buy cars and they can't have problems. And I think we're getting softer, and I don't think you're going to see deflation. Hopefully gas isn't $7 a gallon forever, but I think you'll see, a lot of people received some pretty good raises over the past 2 years, and income went up and expenses has gone out. And I think we're going to see that softening to higher prices, but closer to where supply equals demand, where you can afford to buy bacon and eggs, and do things like that you knew normal. And it's going to be higher than, you're going to look and say, remember 2019 when this cost $3 and now it's $5? Well, you're still buying it, but you're making a little bit more, and it stings, but it'll all even out.
So what do you think for 2023 and 24 is going to happen right now? Just a guess.
Yeah. My crystal ball says we're going to, I don't think there's going to be large economic growth, but I think we'll be into stable economic growth. The world events and macro events play somewhat. I do, in the Silicon Valley, San Francisco world, I think lending into the investments in companies based off of a piece of paper with large valuations, I think those are going to soften. So you're going to have people focusing more on cash flow and profitability versus I want to take this company public in a few years. I think, but I do think what rates will stay in that where prime is in the 3.5% to 4% range. And it's going to take a few years for supply and demand to burn off. Also, remember, there's a lot of government money out there that has been allocated but not spent. So there's still a lot of stimulus money being put into the marketplace that has to work its way through. So, macro events can happen in a shift. can move things in an economy. But I think once we get done raising rates this year, that's where you're going to see the rates. I don't think we're going to see massive run ups in the stock markets and investments and assets. We're not going to see NFT and crypto millionaires and billionaires because they invested in goofy collectibles and now flipping them for huge money. I think you're going to see a little bit smarter money into the economy.
Yeah, I agree with you. I think too, like nowadays, like be really watchful of your expenses, what you're doing, and focus on growing your incomes and building more passive income streams, multiple channels, so you can really sustain, but try to sustain throughout. And the prices for housing, I think it will slowly come down a little bit, not a lot, depending on which market you're in. Like the San Francisco Bay Area, I don't think it's going to drop a lot. It'll drop a little bit because there's still a lot of people out there who make really good money, and the rates do affect them a little bit, but it's not going to affect them forever. And they know too in the future that this rate is only temporary. It's going to go back down, hopefully, sometime in a couple of years, that they can refinance back out of it to a lower rate, but they got the house they wanted to be in. So that's a part of it. And it's a challenge because if you're an investor, you're always looking for cash flow and equity positions. So really try to find out which is the best market for you that can grow even during this time period. There are growing markets still. And if that makes sense, that might have a better number out of state, maybe out of your area, maybe, and take a look at it and figure that out. But
One of the things that we're seeing is a flattening of the marketplace between cities, suburbs, and smaller cities and small towns. That never happened before. And some of it is that work from home, COVID leftover shift of people being able to move, more of a mobile society. So that's going to be an interesting phenomenon over the next few years, too.
Yeah, that would definitely change the playing field because now if you can work from anywhere and the company you work for is open to paying you a certain rate based on your location and it makes sense, then more people can move further out to be somewhere nice, warm, bigger, maybe, and cheaper. Then the rents will slowly rise over there while our higher areas will slowly come down a little bit more as people exit certain areas.
Absolutely. That's exactly what we think is happening and will continue to happen.
Cool. So, any final thoughts about why people should go to credit unions, consider credit unions, learn more about credit unions, investors, and final thoughts?
Yeah. It really, if you enjoy community banking, if you value that relationship with your lender, credit unions are a good play. At the end of the day, this is about trust and it's about being able to deliver. And credit unions are a good solution for that. It's why I'm in this business. What we do for people is, we deal with many, many markets, but if we aren't in a market that we have a direct lender, we introduce them to a credit union in that marketplace who lends in the types of property that they're looking for. So, if people reach out to us, even if we can't help you directly, we always like to try to give you some advice and match you up with somebody locally who can.
Nice. And how did they reach out to you guys?
Sure. The easiest way is we have a couple different sites, but the easiest one is just contact my site, Mark Ritter, MarkRitter.com. And you can put your information in there. We're also very active on LinkedIn through my personal page and through our company. So.
Nice. All right. So thank you guys so much for being on the Truth About Real Estate podcast. If you want to learn more about Mark Ritter, about credit unions, be sure to reach out to Mark and ask him anything about it and see if he can connect you with a local credit union or refer you to a credit union in your area. Thank you so much, Mark, for being on our show. And everyone, we'll see you guys in the next one. Have a great day.